Hello and welcome
Excellent.
to our webinar series for March of 2024. Thank you so much for coming out today. If you're here live, if you're watching on the replay, welcome. Thank you so much for taking some time out of your day to learn about a specific area of investments that I believe is not fully understood or comprehended. And it is especially important, this topic that we're talking about today, in the right before years of retirement and the early years of retirement. So those 5 to 7 years, both before and after you retire, is critical to what we're going to be talking about today, because those are the years that are most affected, the returns in those years of how you will be either successful in your retirement or potentially a failure and run out of money, which nobody wants to do. And so how can we make sure that you're the former, not the latter? And we're going to be talking about that today. But before we get into that, I want to make sure that everybody knows who we are. If you've been around personal wealth strategies at all, you know both myself, Justin, and David Balin here at Personal Wealth Strategies, your financial planners, financial advisors, guiding you through the comprehensive financial planning process, including investments. And so that's who we're going to be presenting today. And if you have any questions, please drop them into the Q&A. We'll love to make this more conversational, answering your specific questions. But we will dive in, and I will share my screen here and go into the presentation. And the title of the presentation is Understanding and Managing Sequence of Returns Risk in Retirement. So sequence of returns risk, that's a weird word, and we're going to work to define that. But what if we could offer you a 5% average rate of return? Would you like that? What if it was 6%, 7, 8? How about 10%? We could guarantee, now compliance, we're not guaranteeing anything. This is just hypothetical situation. Guarantee an average 10% rate of return. Would you accept it? Now, most people on the 5, maybe they wouldn't. 10, probably more acceptors. But what if I told you that the average rate of return was irrelevant if you didn't know that the order in which you got those returns? And that's what we're talking about when we're talking about the sequence of returns risk. Now, David, you want to take this slide and kind of define that?
Sure. So when we talk about sequence of returns, what we're really talking about here is the risk that due to the particular order that these returns come in, that you're going to have a disproportionately poor result. So in other words, it's not a matter of how much the returns or the average returns, but the order that you receive them in. And as Justin mentioned, we talk about this hot zone, that 5 to 7 years before retirement and the 5 to 7 years after retirement. And through the presentation today, you're going to see why that is so critical.
Yep, exactly. Not just what the returns, but when you get them, so critical and so important. And here's a first example. And really, when you're looking at this chart, clearly you want that nice blue line, not the dark blue or black line, because in the dark blue or black line, you're basically at almost zero. And in the blue line, you've got still $2.5 million into retirement. And these may look like you're getting drastically different rates of return, but what if we told you that the average rate of return was actually exactly the same? Now that could be shocking to you because they have such disparate and different results. But what this is showing, and what you see in the line there, is the market is strong in the first 5 years for that lighter blue line, whereas the market is actually flat in the first 5 years. And that difference is what causes such a drastic change in the final result that you get over a 30-year retirement period. So David, this is broken down by numbers. Do you want to kind of take and explain
Yep.
how we got to those charts?
Yeah, so I know most of the people listening to us would probably not accept at face value, even if Justin and I were the ones communicating, that if you had a 6.5% rate of return, that you could have two lines that look so differently. But this chart shows us the model that we're going to use throughout the presentation today. And that is, if we assume you start with a balance of $1 million and that you're looking to take a 4% withdrawal or $40,000 to live off of during your years of retirement. And knowing that inflation is going to erode the value of that 40,000, you're going to say, it's not enough to take 40,000, but let's increase that 40,000 by 3% per year. So that 40,000 goes up every year by 3%, so that I'm keeping pace with inflation. That's our model. That's our assumption. And here are the two portfolios. In portfolio A, we assume the person earns 6.5% for the first 10 years, and then earning 13% for the last 5 years. I'm sorry, I did that wrong. Start at the beginning. For the first 5 years, this person earns 0%. Let's get this right. I was going to say that didn't add up right. For the first 5 years, they earn 0. And then for the next 20 years, they earn 6.5%. And for the final 5, they earn 13. And we compare that to portfolio B, where they earn 13% for the first 5 years, and then the same 20 years of 6.5%, followed by 5 years of 0%. Now you see at the bottom of the chart, both portfolios earn an average rate of return of 6.5%. And just to keep this in perspective, when you're looking online, if you're reading a prospectus, if you're trying to learn about a mutual fund or a particular holding, what do we typically look for? The average rate of return. And what you're going to learn today as you listen to Just Myself is why that is such a dangerous way to look at the performance of an investment.
Great. And so here is that visually again what David was just talking through. And by the way, when we talk about the 4% withdrawal rate, there's been studies around this, and it's changed and shifted over the years. But when we talk about the safe withdrawal rate, many people talk about 4%, and this is part of how they did the study. And so you take your starting balance, you take 4% of that, and then every year you increase that by inflation, so you have the income that you need. But one of the biggest myths about it, the 4% rule, is that you take just 4% of the account balance every year. And if you actually did that and only took 4% of the account balance every year, you actually would never run out of money, because even if you had $1 left in the account and you only took 4% of that, you could still do that and you would be successful. But I think you would all agree that you had run out of money at that point in time if you were left with just $1, and you would still be able to take out the 4%. So that 4% is only relevant in the very first year. And then we increase that, in this case, $40,000 by that 3% inflation every single year. So regardless of what the account value becomes after, we still take that same inflation adjusted amount out. And so in those early years, in scenario B, we're getting a much better rate of return, whereas scenario A, we're just treading water, staying flat. Then we have that 6.5% rate of return for both exact accounts. And then scenario B trails off at the end. We just go completely flat. And then, scenario A, the portfolio starts to take off and average and get 13% per year in those last 5 years. So the averages in the two scenarios are exactly the same, of that 6.5%. The only difference that we're highlighting here, and by the way, we're going to get into, actual real rates of return that have happened historically. So we'll put it into, even greater perspective. But here we're just trying to break it down to its simplistic form of really keeping everything the same that we can, except changing those two drastic, either flat in the beginning and a 13% rate of return, and then or flat at the end with 13% rate of return. And so that sequence in which the rates of return occur is the only difference between these two scenarios. And so how does it affect the value of the investment accounts? And so scenario A, where we had those weaker earnings in the early years, stronger earnings in the later years, the ending balance of that scenario after 30 years is $1,819, meaning $1 million, you've taken out all your income, and you better hope, I guess, if that's all the only money you had, you're on your deathbed, because you're not going to be able to take out another withdrawal of the income that you need in that 31st year. You're pretty much done in scenario A. Scenario B, where we had those strong earnings in the early years, weaker in the later years, your ending balance is $2.54 million. So not only did you take out all of the income over the 30-year period of time, but it over 2.5x'd your original investment of $1 million to have $2.5 million. And keep in mind, the average rate of return for these two scenarios were exactly the same. I mean, this should be, I mean, for me, it's mind-blowing because we always see things, as humans in a linear fashion, and we think average returns are going to be the same, but the order, as you can see, drastically changes things. So Dave, you want to wrap this example up here?
Yeah, in fact, the thing actually, Justin, if you just go back one slide just for a moment, what really jumps out at me is not only the difference in the ending balance, but what does this mean for the lifestyle that you lead during retirement? So the person in scenario A, in their 30th year, has $1,800, and as Justin kind of jokingly said, you better be on your deathbed, because if you live to 31 years, there's not enough money. But let's think back. What would happen in 25 years from the date of retirement? What happens 20 years from the date of retirement? You can see the writing on the wall. You're headed towards bad news. So the person in scenario A is likely not to live the same retirement as the person in scenario B, even though our model shows them taking out the same withdrawals. And yes, Justin, if you go to the next slide, when we look at this visually, you can see very clearly that we'd all rather be the person in the blue line than the person in the black line. So there's the old expression that a picture's worth 1,000 words. Well, in this case, this picture is worth $2.5 million. And it is going to be up for auction at the end of the program, and we'll start taking bids.
Amazing. Do you want to continue with this one, David?
Sure. So we'll give you some time to read the quotes here from Jennifer Reed about sequence of returns and sequence risk. But if you look on the left-hand side, basically what she's saying is that because of the timing of retirement, the person it really will look at this as being poor luck. They just timed it wrong. And we can think about various times in our life. Imagine having retired in 2007 and what happens in 2008, the market collapses. There's an example of a bad return occurring in that first year of retirement. And on the right, this one really kind of speaks to me, and why we wanted to do this presentation is because most advisors and advisory firms are not talking about this. So maybe you're not talking about this, or maybe you're not aware of it, but the people who are out there in our business aren't talking about it either. The focus for most advisors, and for most clients for that matter, has been on accumulating money. Right? Since the day you first got your first job, it's been about, how do I put money aside and make it grow, and make it grow, and make it grow. And the investment advisors who you work with have been talking about, let's get your money to grow, to make it grow, to make it grow. What they're not talking about is this risk of what happens if there's a down year. And how do we develop strategies to mitigate that risk?
Yep. And it's funny too, when we're in the accumulation phase, it's actually the exact opposite that we want, meaning it would actually be better to have worse returns early on in your saving career and those better returns later on. Whereas when you shift to retirement, it's better to have those good years, good investment years early in retirement and have the worse years later, which is, it's very, it just flips on its head. And when you're looking at accumulation, the reason how that volatility helps you, because if you think about it, we talk to our younger investors about dollar cost averaging, putting in that set dollar amount on a given month or time period, and doing that consistently throughout the years. And what that allows you to do is buy in at the average price. But if you think about it, it's actually better than the average price, because when the markets drop and you're putting in that same dollar amount, you're buying more shares in the time when the markets are down. And when the market value is up, you're actually able to buy less shares with the same dollar amount. So you're buying more when the markets are lower, you're buying less when the markets are higher. And that's why dollar cost averaging is such a good thing. Now, when we flip it and we start to take money out of the portfolio on a consistent and regular basis, the exact opposite happens. And so when markets drop and we have to take money out of the portfolio, we actually have to sell more shares in order to get that same dollar amount out. Whereas if the markets are up, we have to take and sell less shares. So we're selling less when the markets are up, selling more when the markets are down, which is actually the exact opposite that you would want to do. And so we go from dollar cost averaging to dollar cost ravaging the portfolio when you do that. And you have to manage the portfolio differently when you're taking money out versus when you're accumulating it. So let's now look at these hypothetical retirement portfolios to somebody that retired in 1992 through 2021 and how using actual returns of the S&P 500 and how that would look for a retirement investor. So this one is, one second, I had a little bit of a glitch in the slides here. So this one is starting in 1992, going to 2021, the same $1 million portfolio, 4% withdrawal rate, then, so 40,000 a year, inflation adjusted by 3% per year, utilizing those actual returns 92 to 21, what you can see, a fairly good result. And if you think about it, 1992 is it's a pretty good time because we had a nice market run, but then you ran into 2000, the tech wreck there, dot-com bubble. Then you ran into 2008, the Great Recession. And so you definitely had some challenging times in here, but all in all, at the end of the 30-year span, still very, very successful, relatively speaking, as an investor. But it's interesting because we can take those same returns and just flip them around. And David, what happens when we do that?
Well, so if we had the ability, or there was an individual who could live their life in backwards, I forgot the name of the movie that described this, but if we could live starting in 2021 and then getting the returns of 2021 and then the returns of 2020 and the returns of 2019 and so forth, what you'd see is that person who originally had a $3 million surplus now has a $5 million surplus. Not a bad trade-off.
Yeah, and the average return, the returns actually are exactly the same. We just reverse the order that they were in. So if we look at that on a visual standpoint, this is what those returns were. So portfolio A, starting with that 4.46 rate of return, going to 7.06, and then if you look at the 30-year portfolio B, 4.46, the same as year one in portfolio A, and then vice versa. So it just goes, completely opposite of each other. So average 30-year rate of return, 9.89%, not too shabby, but wildly different results just based on the order that they were received in. Now, I don't think anybody at the end of either of those periods, those 30-year periods, if we could design it that way, would be unhappy, meaning, $3 million versus $5 million surplus, you had all the money and income that you need and you still have money left over. That's the goal. But what if it wasn't always that way? So here you can see 5.1 versus 3.8, both very, very good years. But let's
And
take,
if that was, Justin, if that was the whole story, you might walk away saying, well, there's not really that much difference. This has been a nice presentation, Justin and David, but let's face it, 3.8, 5.1, I'm going away pretty happy.
Yep.
But
yeah, why don't you
setting
take
up for something?
Let's look at a different time period, 1969 to 1998. Why don't you start with this one?
Okay, so here we're going to use the same scenario as we had before, $1 million to start, 4% withdrawal, which is $40,000 in that first year. And then we increase that withdrawal by the 3% to keep pace with inflation. And what you probably notice, since a picture is worth 1,000 words, around year 25, this person is not going to be very happy. This is not the $3 million, not the $5 million scenario. This is the I'm out of money scenario. And in reality, as I mentioned earlier, this isn't so much that they ran out in year 25, because what would happen in reality? In reality is somewhere around year, I don't know, 6, 7, 8, you see the writing on the wall when your portfolio has dropped from $1 million down to under 600,000. And you're probably thinking, I can't continue this lifestyle of taking out $40,000 a year plus on a portfolio of now $600,000. I need to cut back. So this person who lives this example would make adjustments along the way, and not so much would run out of money at age 25 in 25 years, although that would be true, but they would not be able to live the lifestyle and not be comfortable. That means no gifts to the grandkids. It means not the travel. It means not any of the things that you planned for in your golden years. Remember, this person started in the very exact same scenario as are people who end up with 3 million and 5 million. So there's no reason in year one this person should have expected to run out of money.
Absolutely. So if we go then, second. All right, but what if we take that same scenario, 1969 to 1998, but do the Benjamin Button and live it backwards from
That's the
1998 to 1969 and have the same exact rate of returns, the same average rate of return, but just living it in reverse? You can see a wildly different result here, starting at the $1 million, not running out in year 25, actually having a surplus at the end of 30 years of over $8 million. Again, the same average rate of return. One person has an $8 million surplus. The other one completely runs out of money 5 years too soon. And so that's a big deal. That is wildly fascinating and interesting. And just by switching the order of the returns, do we see that drastic different result? And here's the actual, chart of those various returns as you can see them. Portfolio B having those better years early on. Portfolio A, I mean, having some good years. I mean, year 3, year 4, up 10 and 15%, but you got those two, big clunkers in year 1, 5, and then also in year 6 for portfolio A that it never ends up being able to recover from. We're having those same large downturns in portfolio B, but much later on in the sequence, even though the average 9.82% still the same, you have those two drastic different ending balances and results.
Yeah, you can even ask the question when you're looking at those big numbers in portfolio A for the last 5 years, what difference does it make? If I have $0 left in my account, if I get a 30% rate of return, my elementary school math tells me that 0 times 30% return still leaves me with 0.
Yep. Yep. And the poor person in portfolio A, they were so close. Even if they did make it to year 25, they wouldn't have had, and had a little bit of money left. Look at these returns that they missed out on because they had no money invested in 27, 28, 29, and 30. I mean, that's a tremendous run of investments, but they completely missed it because they didn't have the money invested and left over. Whereas having that at the beginning for portfolio B, being able to capture those returns and get that head start, rocket fuel that they were never able to, spend down. That is the big difference here, getting those stronger early years and weaker later years. And now the question that I would ask is, what are the takeaways here? Because what are we going to do? Are you going to do to be able to because we can't control market returns. We don't know the order of the returns. If we did, we would say, yeah, this would be a great year to retire, because we know the next several years are going to be great. We can't say that. And so if you recently retired, and let's say you retired, at the end of 2021, which was a great investment year, but then your first year was 2022, where both stocks and bonds were down. I mean, that's a tough way to start your retirement, knowing what we know now about the sequence of returns. And so what are those key takeaways since we can't control the returns that we get and we can't know the sequence? Number one, awareness. Attending this webinar, watching this on the recording is the first step. But now what are the actual action steps that you can do since we can't control those returns? So like we said before, sequence of returns, it's not just what returns that you get, it's also when you get them. That's critically important to remember. Now, also, we have to think about longevity as well, because the longer we live, we were looking at 30-year scenarios. What if we looked at longer? You're retiring earlier, living longer as longevity takes its hold, and so as a result, we might need to reduce that safe withdrawal rate even further. With the 4% rule, as people were talking about it before, all of a sudden became not a rule anymore. It became like a guideline. And then it became, well, actually, maybe it's a 3.3% rule. Well, maybe it's a 3%, maybe it's a 2 point, and it keeps changing. It got lower and lower and lower to get that safe withdrawal rate. And so that, drastically affects what you can take out of the portfolio if you can't use, that 4% that you were hoping for, or even, higher than that. But one of the things that we can do to help reduce that sequence of returns risk is looking at different investments, meaning that we were looking at all stock portfolio. And this is one of the reasons why allocating towards fixed income or bonds or other safer investments as you start to approach retirement is the recommendation It's because of the sequence of returns risk, meaning that bonds typically have a lower volatility than stocks do. And being able to reduce that volatility in, those later years, right before you retire and the early years within retirement really can help to isolate you from that sequence of returns risk. And so that's first number one of what we can do is look at the investments that we're in. Are we all in equities? That might be great, and that probably is great in the accumulation phase. But as we start to approach the decumulation phase, that may be subject to risks that you don't want to take. All right. So what are these approaches that and how can we help you? So David, why don't you take this first slide here?
Okay, so I mean, there are a variety of ways that we could help. The first thing that you want to do is you want to explore ways to increase your guaranteed income. I don't know why anybody would not want to maximize their guaranteed income, and yet people don't always think of this as something to look at. The second thing we're going to look at is we're going to look to skew your fixed income investment, your bonds, your fixed income, your mutual funds, your CDs. We want to skew them to avoid volatility. So that's a word we haven't used yet in the presentation, I don't believe. But what we're trying to do here when we talk about the sequence returns is to reduce the volatility in that hot zone right before retirement and right when you get started. We're going to continue to tilt towards small company stocks because, believe it or not, having small company stocks that offer higher potential rewards actually can help you achieve a more safe retirement. So now let's look at each one of these a little bit more in depth.
All right. So what are the guaranteed income sources, David? I mean, we got Social Security here, and what else?
So, well, before we go beyond Social Security, let's spend a moment on Social Security, because one of the things about Social Security is this is probably the decision of when to start your Social Security retirement benefits is probably one of the most important and impactful decisions you're going to make regarding your finances. And yet we find people all over the place, partly because they'll listen to whoever they want to give credence to about when's the right time to take Social Security. But the answer here is that the earlier you take Social Security retirement benefits, the more potential volatility you put into your portfolio. And it's probably never been presented to you that way, but Social Security offers a guaranteed monthly payment to you, regardless of what happens in the markets. And unlike most pensions, even assuming you even have the option of having a pension, unlike most pensions, it's adjusted for inflation. So those who lived through 2022 as a retiree got hit on the chin on retirement, on inflation, as we all did. But those who were collecting Social Security got a 9% increase on their monthly payment. The rest of us were trying to catch up, and we know how painful that can be. Another thing to consider about Social Security is under the worst case scenario, 15% of your Social Security check is exempt from federal income taxes. We sell a lot of different types of investments. We advise people on a lot of different things. We don't have that many things that are guaranteed and 15% tax-free. And the idea about when you take Social Security is very much predicated on for married couples based upon the higher income person delaying as long as possible, because that higher income person triggers that survivor benefit at the time of their death. So we really want to make sure we spend a lot of time on that Social Security decision, make sure we get that right.
And David,
that becomes the foundation.
I think we had a full webinar on Social Security that you can also watch on our YouTube channel as well. That would be beneficial if you want to dive deeper into the Social Security discussion.
We did, and that's a great recommendation. It's something where you really want to make sure, because as I said, it's a very important decision. But if you don't make the optimal decision, it means that all these other decisions that we're going to talk about have to make up for what you did not make through Social Security benefits. Taking a look at those who have pension plans, so what we refer to as a defined benefit plan, where whether you should choose to take a lifetime income stream or take a lump sum distribution. And even within that lifetime income stream, most people are going to be given a choice. And that if they're married, they're going to say, do you want to have a benefit that's paid to your spouse at the time of your death? And if you decide you are going to take a lifetime income stream and you are married, you're probably going to say off the top of your head, well, of course, I want my spouse to continue to receive my income. But if you choose that option, recognize that you're going to give away about 15% of your monthly income to guarantee that stream of income to your spouse. Now, maybe that's a good deal, maybe it's not. That's a discussion for another day, and maybe just another webinar we want to do. But you might ask the question, if I give up 15% of my income in retirement, what if my spouse should predecease me? Well, in most cases, that was an insurance that you bought. And like most insurances, if you don't have a claim, that money is just gone. So you've given up 15% of your income stream to protect your spouse. And yes, it gave you peace of mind, but you may ask the question whether that was the right decision. So decisions around pension plans becomes a big deal for those who have pension plans. And then we want to look at other options for guaranteed income. Settlement options in terms of how you take payment, much like the pension, there's contracts that you might have. You might have annuities, you might have investment accounts, you might have IRAs, where you can choose to have these pay out over a period of time. And then today, one of the things that's very popular, income annuities, turning over a lump sum of money to an insurance company in exchange for lifetime payments. And with today's higher interest rate environment, those lifetime payments can be quite substantial, which means that you can turn over a smaller amount to an insurance company to get a larger amount guaranteed for life. But by having this guaranteed income piece, it allows us to manage the investment side of things very differently.
Yep, and that's an important piece as well, because it's a combination of all of these things, like the proper Social Security claiming strategy. Whether or not to do an income annuity, it's not always beneficial, but sometimes is. But typically, it's not going to be everything that you have, because you also need that flexibility piece. Because if you turn everything into income only, and then you don't have an additional expense that comes up and you can't cover it, that's not going to be helpful either. So it's going to be a combination in order to get that diversification to help you achieve those goals and avoid the sequence of returns risk as best we can. So this one I'll take in terms of the fixed income portion of the portfolio, because really when it comes to that sequence, we want to be able in those years, if we do have down years in the market, where can we tap into that is not going to have that amount of volatility, meaning we can sell from some of those safer assets to allow those other market assets to recover. Because if they're down, we want to give them, not take money from them if they're down. Ideally, we would let them increase back up. And this is where we use high quality, short duration bonds, CDs, even some shorter term annuities can work in like multi-year guaranteed annuities. Even some fixed indexed annuities potentially could work in this situation where you're getting less risk there and more safety and security to take some money out in those years where the markets are volatile. And even in a rising interest rate environment like we've had over the last couple of years, where if you had a longer term bond, I mean, it doesn't help in 2022 when stocks are down 18%. If your long-term bonds are down 20%, I don't think you'd be better off holding those long-term bonds. It was those shorter-term bonds, albeit still down slightly in 2022, but down way less. You're able to preserve that principal better, because in a short time period, the principal can be redeployed into new higher rates. And so that's what we're beginning to see right now. Rates are continuing to stay high. That shorter term debt that was purchased a couple of years ago, now coming up for renewal, now getting into much, much higher rates, which is going to help the portfolio long term. David, you want to take this one?
So, yep. So let's look at the idea of tilting towards small company stocks. So as a young investor, you probably knew that you wanted to buy small company stocks because they offered the opportunity for higher rates of return than even large company stocks. But how does that play out for an investor trying to live on a an annual distribution. Well, the reason why small company stocks can be so powerful in an investment portfolio is, let's go back to our model in the beginning. We said an individual had $1 million and they were trying to withdraw 4%. Well, in a typical fixed income market, typical market, you might take that $1 million and invest it in bonds and get a 4% rate of return. There's your $40,000. In fact, for those of you on the call here or the webinar who have the grayer hair and perhaps less of it, as I do, remember the days when you could put your money into a government bond and get perhaps 7 or 8%. And you say, well, I know my retirement strategy. Take my money, put it in a government bond, and go away. I don't have to worry about taking on risk. But the reality of the situation is, even if you could get that 4% rate of return, what did we ignore for a moment? We ignored that 3% inflation component. How do you get more than 4% if we're all in a bond? Now let's take a different scenario. Let's take that same $1 million, and let's say that we still want to get that 4% rate of return, $40,000, but we were to put it into stocks. And for the moment, I'm not even going to go into small company stocks. I'm going to use stocks in general and say that the average rate of return on a stock portfolio is about 10% per year. 10% of them would only require us to put $400,000 in stocks to generate $40,000. Now, it wouldn't happen every year. Okay, we know that, and that's the whole reason we're having this presentation today. But it would allow me to put 40% in stocks and on average get a 10% rate of return, and take $600,000 and put it into my fixed income and safe alternatives, as opposed to managing a portfolio of $1 million and trying to figure out a way, how do I get a low risk way of getting 4%? By taking on portions of the portfolio that offer higher rates of return, it actually allows us to put a bigger percentage of our money in safer assets that have less volatility.
So this is not a fun conversation here, but working longer or changing the way you retire is also another potential answer. So having some flexibility in, working part-time, and we typically see this anyway, just from a lifestyle perspective. There's very few people that say, I want to retire and I don't want to do anything. The people that do say that don't do anything for a little bit, and then they're they're coming in and saying, I'm bored, I need to do something. And so typically people are going to be doing something with their time. And just the way that our capitalist structure works, when you do something with your time, typically you get compensated for it, unless you're doing it completely for charity or for complete fun. But there is some component there. So allowing you to not retire completely and start to live off the portfolio, especially in those earlier years where we have this bigger portion of potential need, you can continue to either save or just let the portfolio sit and grow while you're spending the money from your part-time employment during your pre-retirement. This obviously relieves the portfolio, so you don't have to generate income right away. It also, on the back end, if you in those first 5 years, let's say, don't take from the portfolio, now it's reducing the total number of years that you're going to have to provide income, assuming you live the same amount of time. And it's much, much easier to continue working right after you officially retire than it is to completely retire, be retired for a long period of time, and then say, whoops, it's 25 years in. Guess what? You're 90 years old, and let's find a job for you now. So much easier to continue working than to have to go back to work much later on in your retirement. And so that's a pretty good strategy that you can look to potentially adopt if the numbers are going to be close for your retirement.
So Justin, one thing that I want to point out here, I think people listening know this, we sometimes take it for granted, but we work as fiduciaries. And what a fiduciary does is we are obligated by law to act in your best interest. And being in your best interest sometimes means delivering news that's not so good and giving you an honest appraisal of where you stand. So one of the questions that may be going through your mind is, all right, this has been great, but where were you guys 5 or 7 years ago when I entered this hot zone? And now I'm already too far gone, and perhaps maybe I've lost money and I'm not in the position. What do I do now? Right. So if we've already been in that scenario, earlier I said imagine someone who retired in 2007 and watched their portfolio in 2008, where the S&P 500 was down 35% and the foreign markets were down 45%. What do you do in that scenario? Because nobody had a crystal ball saying that was going to happen. And with all the strategies that we're talking about, we could mitigate some of that loss, but there would still be loss. What happens for someone who retired at the beginning of 2022, when the S&P 500 was down 19% and the bond index was down 13%? Well, you go to the fiduciary who you have working with you, and maybe you have to revisit this employment question. Maybe it means you do some part-time work. Maybe you do some consulting. Another idea is perhaps forego the inflation adjustments. So remember, we started off with $1 million, taking out 4% or $40,000 and increasing it by 3% per year. So at the end of the first year, that $40,000 would go up by 3% or $1,200 to $41,200. What if you just forego or gave up that 3% increase and you just stayed at $40,000? Well, that would have a dramatic effect on your overall portfolio, because not only are you giving up that $1,200, but you're giving up the compounding on that $1,200 in years going forward. Most people would look at the situation and go, wow, I took a big loss, I better start cutting expenses. And you're going to, maybe you look at it and say, well, we're living off $100,000 of income in total. Maybe we'll try and cut down to 50. Well, if you're living off $100,000, I'm going to tell you, it's pretty hard getting down to $99,000, right? Let alone making a big dramatic cut down to 50 for the 1 year. But to give up the 3% increase, maybe you can pull that off. And if you do that, you're in a better position going forward. So your financial advisor, your financial planner would be in a position to help you see some of these options that you might not otherwise see. But the bottom line is, regardless of whether you're in a good year or a bad year, you want to make sure that your financial plan stays up to date. And that's where it's important that you meet with your financial advisor on a regular basis. Whether you're working with our firm or another firm, you don't want to fall into the trap where if you have a particularly good year, you figure, what's the point of going? Everything's going well. And then you have a bad year and you say, I need to call them up and find out what's going on. Because that's not going to help. You need to be able to stay on top of things as you move forward.
Awesome. We can get to some Q&A if you have it. And now I can make up one as well, and I'll give you some bonus material here, because something else that we alluded to but didn't talk to directly is the idea of having a buffer asset, meaning an asset that is even completely potentially outside of the portfolio that you could tap into in years where the markets are down, giving them time to recover. And I'll give you, 2 examples that I can think of off the top of my head. One is relevant to most people on the call if you own a home. And that's the ability to do a home equity conversion mortgage, being able to have a line of credit on your home that you have access to. And in years where the market's completely down, you can then lean to that buffer asset, because that's not tied to the markets. You can take the money out there, have your same living expenses. And then in the next year, assuming that the markets are now on their way to recovery, you go back to your main asset and then restart the income from that. And so you could do that via the home equity conversion mortgage. By the way, we've got a full webinar just on that from an expert in that area. If you have a permanent life insurance policy, a whole life or a universal life insurance policy that has a cash value, that's not going to be fluctuating. If it's a variable policy, probably not helpful. But if it's a whole life policy that gets the dividends, you could take a loan and borrow against that policy in a year where your markets are down to help to offset some of the potential sequence of returns risk there. So having the idea of potentially tapping into these other assets in specific years where the markets may be down is also a helpful tool.
Along those lines, Justin, one of the things that I'll mention as a bonus item is, if you're working with a financial advisor, they probably have a program. We use a software package called Money Guide Pro, which allows us to put in assumptions about growth on your portfolio and allows us to stress test it. And in the program, it allows you to go into what's called the play zone and ask a lot of what if questions. What if tax rates go up? What if Social Security gets cut? What if inflation is higher? what if, to the point where you can develop a portfolio and say, all right, I'm comfortable that all those possible scenarios that I came up with, even if they happen, I know how I'm going to react to them. Most people start the journey on day one of retirement, and after the party is over, they assume that every year is going to return that fixed 5, 6, 7, 8% rate of return. But in reality, life happens. And even if somehow you could pull off a 5, 6, 7, 8% rate of return on your money, guess what? You can't pull off the expenses staying level. There's going to be, as I like to say, there's nothing more expected than an unexpected expense. There's going to be a medical bill, a child who needs support, a grandchild who needs a medical procedure, an education that needs to be funded. There's going to be all kinds of things that you don't necessarily foresee on day one. And therefore, you need to have the flexibility in your program, in your plan, to address those issues.
Yeah. Awesome. So with that being said, if you are a client, speaking of that software, and you're not taking advantage of it, reach out to us, contact your advisor. We'll be able to make sure we can get you set up on that program and you can start to utilize that and see things for your retirement. If you're not a client, this was not planned, but I think what we can do, David, is for the first 3 people that book a session with us, we'll be able to give you that Money Guide Pro software as well, so you can start playing around with that, loading stuff in to give you an idea of where you are in your retirement. That would be at absolutely no cost to you, completely free, just for attending or seeing this webinar for the first 3 people that come through it. So there'll be a link that I'll post in here now, actually, if I can pull it up quick enough. If not, there will be, I'll send it in the emails out with the recordings to the attendees and the registrants.
And Justin, while you're looking for that link, I'll just throw one other thing out. And that is, if you are a client and you said, well, this is a nice presentation, but I feel very comfortable that things have been taken care of for me in this regard. Remember that there's probably people in your life who do not have that same level of comfort. And ideally, the time to make an introduction would be a time before the crisis occurs. I tell the story in 2008. We had a number of people who were introduced to our firm, and they'd come in to say, "Hey, Dave, I need your help." And I said, "Well, tell me about what you need." And they say, "Well, I lost 50% of my portfolio during the market declines of 2007 and 2008. I need you to get me back." And I would say, "Okay, we're up to the challenge. I just have one question. How much time are you going to give me?" And they'll say, "Well, it only took me a year to lose the money. How much time do you need?" And I would say, "Well, think about the question that you've asked me. You lost 50% of your money. You want to get back to where you were. You're asking me to double your money. And you want it done in a year? That's not going to happen." So when is the time to take action? It's before you lose the 50%. So if you do have people in your life, family, friends, neighbors, whoever it might be, who you think could benefit from taking steps to prevent that type of loss, we would be happy to help in any way that we can.
Awesome.
And during that time, Justin was able to post the link.
Yes, link is there. Thank you so much for attending. Any follow-up questions, we're definitely able to get them via email as well. And we look forward to seeing you next month, the first Wednesday of the month, 12 noon. We've been here for over 2 years straight now, each month coming to you with content. So we look forward to seeing you next month.